Hi guys, hope you guys are good and welcome back to today's video where we'll be doing a weekly outlook video on US30, right? So to give you guys a bit more of a perspective on things, I will be looking forward to releasing a lot more videos on the indices, be it weekly outlook videos, daily ideas, all of those sorts of things. And by indices, I do mean US 500, US 100, and US 30, right? But in today's video, we'll focus primarily on US30. And the reason for that is because out of the three, US30 is looking much more clearer, right? In terms of its expectation, in terms of my expectations on it. But we will get into that, right? So it will happen at times that I release a video which will primarily be on NAS 100, and maybe sometimes I will release a video that's based on all three of them. It all just depends on the price action that's given at that particular time, right? But that's not to say that I will stop releasing videos on the Forex side of things. I will still continue to release weekly outlook videos on the DXY as well as GBPUSD, right? But the reason for this adjustment, and I will explain why. The reason for this adjustment is due to the fact that when it comes to Forex, I trade GBPUSD primarily, right? And I'm looking to make a switch from trading forex into trading indices only, right? So when I started ICT, I used to trade indices only, and then I made a move to forex, and now I'm planning on going back into the indices again, right? So at the moment, I'm currently just back testing and forward testing the indices to get back into that groove, right? But eventually I'll fully make that adjustment. But like I said, that's not to say that I'll stop releasing videos on the Forex side of things. I will still continue to release videos and ideas, right? But the main reason why I'm making this adjustment, right? And but before I get into that, for you guys who are just primarily here just for analysis and all of that, you can just continue to feel free to just continue to fast forward to the analysis section of the video, right? But yeah, to give you guys a bit more perspective on things, the reason why I started, the posting my analysis on TradingView and all of that is due to the fact that I hated the traditional sense of journaling, right? So I figured, you know what, let me journal through releasing my ideas on TradingView, right? And then that led to me making videos because I'd get, good feedback from you guys, and I appreciate you guys for that. And then that eventually led me to going into releasing videos on YouTube as well. So I really appreciate all of those 300 and something followers on YouTube, the followers, the 600 followers on TradingView. You guys do really mean a lot. The feedback that you give me really does mean a lot, right? It gives me an idea that, you know, whatever I'm releasing and whatever I'm saying is actually valuable, right? And me just having to post my analysis, whether it goes wrong or right, it just makes me more accountable of things, right? So, yeah, so the narrative behind why I'm making this adjustment is due to the fact that, so this whole notion of the architect really stems from, who I am as a person. I am an aspiring architect, right? I recently graduated in architecture, my undergrad architecture. For you guys who live in South Africa, I graduated in Wits University, right? And so for these past 4 or 5 months, I haven't been working in a corporate environment. I've been working for myself, basically just freelancing. And the reason for that is due to the fact that if I were to be working in a corporate environment, because of our time zones, it already aligns with my London session and my New York session. So already when the year began, I made the decision that I won't be working in the corporate environment due to the fact that I trade Forex, right? I trade GBPUSD, London session, New York session, and those times clash, right? So that's why I had made that decision. But as far as architecture goes, I'm very passionate about that, and I'm still looking forward to continue going into my masters and my honors. But before, going into that, the requirement for me to go into that is to have a 6 months internship under an architect. So the freelancing that I'm doing for clients and all of that doesn't count. So I actually have to work under an architect, which means I have to work in a corporate environment, which means, again, I cannot trade, my Forex during the day, right? So that's what led me into going back into indices because I used to trade when I was still back in school last year. In fact, when I started ICT, I should trade indices, New York session only, New York session morning, and New York session afternoon, in which the market would be very volatile during those times, especially in the afternoon as well. So immediately I made the decision that okay, it's cool. I can go into the corporate environment, work during the day, and then in the evening I can just trade for those 3 hours, the afternoon session, which is perfect for me, right? And it's also perfect in the sense that as I was working for these, staying at home, trading for these 3, 4 months, um, and I'm a day trader as well, it would happen at times that I approach trading London session, and 2 hours into London session, I'm already done trading for the day. And then I have the rest of the day and I'm just doing nothing, right? Trading for me, you know, just for me personally, right? I find it boring in the sense that just having to do trading, right? It becomes very tedious, right? And I'm a person who's I love working with my hands. I love construction. I love architecture, So me just being confined to only that space, I don't really, I'm not really, finding it well, or, I don't know if you get what I mean. But so, yeah, that's my decision. So that's why I'm fully making that adjustment where I'll eventually go into just trading indices, right? But hope you guys understand. But with that being said, let's get into the video, right? Okay, cool. So when approaching US30, all right, we can understand that in the traditional sense, the US30 has been bullish, right? We've been bullish for a very long time, all right? And how we approach it in terms of ICT, we need to understand what is our draw on liquidity, right? Because once we have established our draw on liquidity, we can then go on to our 15-minute time frame, our 1 hour, make our entries on the 1 minute based on targeting that specific draw on liquidity. So that's how we're able to, you know, catch those, extreme high risk rewards, right? By just having to get an understanding on what are we anticipating in terms of draw, right? So there are only two draws on liquidity that the market will always be looking forward to reaching, which is external range liquidity, which exists at highs and lows, and then internal range liquidity exists as fair value gaps, auto blocks, right? So to give you guys an example of that, you understand that here the market pushed into external range liquidity where it took buy stops, right? After taking buy stops, you see the market draw in towards internal range liquidity being the fair value gap. So once price reaches that, you get an understanding that you can continue the market higher as to reach the buy stops, right? So you follow that narrative the whole time. The moment buy stops get taken, anticipate the market to sell off into internal range liquidity, be a fair value gap, auto block, and then get more confidence to continue the narrative as to reach into external range liquidity, right? And you follow that narrative the whole time. Buy stops get taken. In this idea, we see the market give us a market structure shift over there. This is also regarded as external range liquidity. So what does the market do? Pushes into internal range liquidity, that's where you're looking for selling, right? To target external range liquidity. So you follow that narrative the whole time, right? But now, in terms of premium and discount prices, we understand that this is our extreme high over here, long-term high, and this down here is our long-term low, due to the fact that this area of price action is the most efficient price action, right? This is a balanced price range. So we have an understanding that the market won't look forward to going beyond that point because it's extremely balanced out. Both buy side and sell side delivery was delivered over here. So that is my long term low. That is my long term high over there. Right. So we understand that from a premium price, the market moves into a discount price. right? But now the question is, why did it exactly move all the way down here, and then why did it establish a low that continued towards the upside? So we're continuously taking external range liquidity, right? And what we see the market doing is from this premium after buy stops had been taken over here. And the way buy stops were taken, by the way, is the market had established this a retail pattern, resistance pattern over here. And that's what smart money tends to do a lot, right? You'll see in this instance, smart money used the trend line to engineer trend line liquidity, which means what? Where are the investments? Where are the stop losses, right? They're at the lows. So those are regarded as, you know, sell stops. So they engineer this liquidity and they use it as a point to target for future investments. So in this instance, they engineered liquidity using a resistance zone, right? Because us as retail traders, we're going to be continuously selling this. Where are the investments? Where are the stop losses at? They exist up here as buy stops. So they eventually push the market as to manipulate against that, take the buy stops. Now they have willing buyers to sell against. So now they're selling at a deep premium. Where are they going to be looking to take their profits? At a discount, right? So they move the market into a discount, but now they in the market, they need to target a point where they're going to be taking their profits at. So now the question is, where are those points? Those points are at areas of inefficiencies, right? Inefficiencies such as liquidity voids, fair value gaps, because those are areas for smart money to book their profits. Those are areas of fair value. So there's this concept called fair valuation, right? Now, looking at a liquidity void or that area of fair value, we understand that looking at these last down close candles here, which is the order block, this is the last point we saw sell side delivery, right? We saw a bit of buy side delivery, then we saw sell side delivery. So from this point, we just saw buy side delivery all the way to the upside until this last black candle over here. And then eventually these wicks tried to fill that inefficiency, right? So there's still this much of an inefficiency that's still left. So that's the area of fair value. So that's what makes this order block extremely strong, right? So that's how you mark your order blocks. If there's an area of inefficiency right before the order block, a fair value gap, all of those sorts of things, that becomes a strong order block. So the market, once it reaches that order block, fair valuation has occurred. So smart money at this point looks to book their profits. They take their profits at a area of fair value, which is also at discount prices. Now, this liquidity over here, the trend line liquidity, is regarded as sell stops. So what will they be looking to do against those sell stops? They will be looking to buy against those sell stops. So all of this is regarded as internal range liquidity. The order block is regarded as internal range liquidity. So from internal range liquidity, where would we like to see the market go? To external range liquidity. So that's how we see the market draw all the way up there, right? Now, once we've taken out external range liquidity, the next idea or draw should be towards internal range liquidity, right? So this is our low, that's our high. We're currently at a premium, right? We need to establish where's the market most likely going to draw to next. Is it going to be respecting these fair value gaps, right? But the question is which one? Or is it going to be looking to draw all the way into our bullish order block over here? Now, the narrative is we understand what makes this order block strong. This is the last point we saw sell side delivery. Right after that, what do we see? Only buy side delivery towards the upside. So, this is the last point we start to see selling start to step into the market, right? Now, that gives us an inefficiency, a liquidity void, an area of what? Fair value. So if they're continuously selling at a premium, these are areas where smart money will be looking to book their profits at, right? But we understand as well this concept of fair valuation. So we'd like to see the market eventually fill this inefficiency, right? So there's also a concept that I looked into that I did a few months ago when I was speaking on NAS 100. I will link it where I was talking about high probability trading environments. So areas like these are regarded as low resistance liquidity zones, where the market has low resistance to run against. There is completely no resistance at all over here or support, right? So the market will slice through all of this. So that gives us an idea that this bullish order block over here is potentially going to be our next draw on liquidity. So the market may continue further into deeper premiums, be it this fair value gap over here, but then off of that point, we'd like to see new selling step into the market to give us an idea to draw the market all the way down there. So that's already our draw on liquidity, right? Now, we understand after these buy stops get taken, we get a market structure shift over here. This is regarded as what? External range liquidity. So eventually we may see the market draw into internal range liquidity. And then possibly we'll see the market continue all the way down, right? As to reach into our draw all the way down there. So it may continue directly, or we may get that pull back into the fair value gap and then continue lower, right? But with that being said, let's go on to our H4 time frame. Just clear these things up. Okay, cool. So that's that area where we took the weekly buy stops. What do we see on the H4? We get a market structure shift. Price pulls back into, remember, external range, pulls back into a H4 fair value gap aligned with a break over there, internal range liquidity. Then we'd like to see the market reach out to external range liquidity. So that's how the market tends to move, right? So we've established that the market, in terms of institutional order flow on the H4 is completely bearish, right? So we continue all the way to the downside. That's that market structure shift on the daily time frame. What starts to happen down here is we establish this resistance zone. What is happening here? Engineering liquidity again. Remember, it will always use smart money will always use um, retail patterns, right, to engineer liquidity, be it a trend line, be it support zones, and all of that. So this is engineering liquidity in what sense? It's giving us the idea that this support is going to be held and we can continuously buy this. So we see the reaction towards the upside. But smart money will sell against that. And where are all the stop losses? At these lows. Sell against it, push it you know, into the sell stop region, and then look to buy against that. Buy against these sell stops. Now, note this. Note what is very important. This region over here, that's the last point we see sell side delivery. Until what? This is the last point again we see sell side delivery over there. What is this? Liquidity void. What is this area? An area of fair value for smart money to look to book their profits. So all of these sell orders that they had been entering, right, in this fair value gap continuously towards the downside, they'll look to scale out those positions at this area over here. And then what's also aligning with this liquidity void are these sell stops. So now they look to buy against these sell stops to draw the market where? Higher. So now there's a likelihood that the market will draw higher to take this region over here, these buy stops. And then secondly, what? To fill this inefficiency here, right? We also have this inefficiency. But let's go into the H1 time frame so that we can fully look into that narrative, right? So we've taken those sell stops over here on the H1. We've taken this. I did post this analysis yesterday. I didn't trade it, however, where I was talking through. So already we have the narrative or the idea that in terms of the US30, we'd like to see the market continue towards the upside. I posted this analysis yesterday, but I didn't trade it due to the fact that it was a bank holiday, right? I was speaking through the idea of why this support is basically fake, right? They're just using it to engineer liquidity. They're going to push the market lower all the way down here. I wanted to trade yesterday, then I realized, of course, it's a bank holiday, so I didn't trade. And then over here, I mentioned that if price gives me a confirmation, I'll then look to target these bullish objectives, being the buy stops up here, and then eventually draw all the way up there as to fill that daily time frame fair value gap. I'm seeing the market completely fill it due to the fact that we saw this heavy delivery of price action towards the downside. What does that give us? It gives us the idea that this area over here is inefficient. This whole area gives us an idea that it's a low resistance liquidity zone, right? So the market can easily trade through all of that. I will link a video to, liquidity runs and high probability trading environments in terms of liquidity runs, right? So this is the next area of inefficiency. So if smart money is looking to buy against all of these sell stops at a discount region, discount price, where's the nice area for smart money to look to book their profits? These areas over here, right? areas of inefficiency. So I'd like to see the market completely push all the way up there. Um, continue. That's my first bullish draw, and then eventually continue towards the upside, right? But of course, I ran out of time, but I hope that gives you guys a bit of an understanding, right? But with that being said, kind regards, the architects.